Good evening, everyone. Time for another silver update. This is the 1 hour chart of silver provided by netdania.com. You can click on the link below. A couple of things on this chart. First of all, you can see the strength of the rising trend line that we're in. We actually have this modified trend line as we begin to arc up towards the upside. Now we had the interesting smackdown that we had as we broke through the technical point of 34. As I've been saying, 32, 34, and 36, these are the key numbers we're looking for with silver. But a couple of things on the MACD I wanted to point out. You can see that when we look at this descending MACD trend line, which is a mirror image of this ascending trend line, which in my opinion is a very bullish scenario. But you tend to get at market turns, as I've described before, at market turns, you can get a change in the behavior of these technical indicators. Normally when you have a very long-term rising bull market, the buy signals are valid, such as here, 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 and potentially here. And the sell signals become invalid. So you can see you had a sell signal here. It was quickly violated right there. That was followed by another sell signal that was quickly violated. So the general rule for using these indicators is that they work primarily in a trending market. Now what's so interesting about this change from about the 28th of December or so is that these buy signals are starting to work very well, but the sell signals are being overrun very quickly. You can see we had a sell signal here, and even though the MACD didn't make a new high, it was overrun. So our MACD is declining while our price is rising. That's a very bullish scenario. It appears that this is a bottom. We do want to go out to the weekly view and take a look at the crossover of the MACD. Now, as I was hoping for, I wasn't expecting, but I was hoping for a decisive cross in the MACD on the weekly chart. We do now have a decisive cross. That doesn't mean that we can't reverse and go the other direction. You can see, like right here, it seemed to be a fairly decisive cross, but we actually reversed, went the other direction, and the rally didn't start until the beginning of QE2 in August of 2010. So we actually spent the larger part of that year just churning. So it's not a 100% inviolate rule, but it is a very encouraging sign that the MACD has crossed so strongly and decisively to the upside that we probably will continue to rally for quite some time. You can see that the 5 that we reached on the MACD is a very high number. If we get back to that 5 on the MACD, I can't even estimate what the price will be. And if we actually exceed that, as you can see, we've got this rolling up on the MACD. If we actually do a continuation of this pattern, then the MACD may do something like that, which will actually see a 10 on the MACD, and you could easily see $150 silver if that happened to occur. So that's a very interesting scenario that's beginning to play out. Now I wanted to take you over to a post that I did this morning. This is the first time I found these tools on NetDania. Tremendous site, very useful. Really appreciate them, and if you have the money, please subscribe to their site. It's for high-end traders, but they really have great tools. So I utilized their tools this morning and managed to put in some arrows and a comment here, and you can see that what I tried to document is that we had this nice breakout rally in silver. Now you can't see it on this chart because it's too close up, but the key level was 34. We broke through that in a fairly decisive manner, and then we started to fall back and test that breakout point. That's fairly typical in a Jesse Livermore type support resistance situation. But what was very unusual about that was that after we'd broken out and fallen back, we were churning to test the breakout point. Normally, you'll test back and then continue up. That's the normal situation in a bull market. But what was interesting was that we got this tremendous assault against the euro that came in right after that, and you can see they violently sold off the euro at this point, and it took a good, this is the 1 minute chart, so each of these bars is going to be 1 minute, but you can see it took a good 20 minutes or so before silver finally relented and came down and started its decline based on that move. Now, it's my opinion that of course it's my opinion only perhaps, but it's my opinion that silver is the key to the financial catastrophe and the manipulation, etc., not gold. If we look over at the gold chart and pull up that 1 hour that we had, you can see that gold did something like that, but we had these other highs here with gold. So the breakout in gold that wasn't really a breakout, was just kind of a little rally. The main action that occurred was in silver, was this decisive pop up above 34 and then the smackdown. So my contention is that the smackdown came from dollar support, and I think by checking, and the other chart we want to check real quick is the Japanese yen, because it's very, very sick. The dollar is very sick against the yen. And as I pointed out on a couple of charts I posted on my blog, the yen dollar cross is starting to get into that very interesting, well, we'll pull back one here, that very interesting Fukushima territory. If you remember, the Fukushima low, which was at about 76.65, was, of course, when it initially occurred, we had a violent rally that was central bank intervention. Now, we had another central bank intervention when we crossed it. We had a mini one here. We had another violent central bank intervention there, which, of course, I pointed out before, is to punish any traders who take a fundamental view. The central banks of the world do not want people making bets based upon the fundamentals. They want people to make bets. Well, I don't know what they want them to do, but they certainly don't want people to make money from the failure of central banks. So you can see we're now approaching this very dangerous area of central bank intervention, where they do not want the dollar to depreciate much more against the yen. Now, if you remember at the Fukushima low, the explanation was given that they needed to help Japan in defending their currency. Actually, the opposite, in weakening their currency so that their exporters could make a profit. I think I've done a decent job in my past videos in explaining that whole thing is a complete fraud, because, of course, when you pull out to the long-term chart, you can see that the dollar has continuously declined against the yen, and Japan continues to sell its goods worldwide. So the whole currency, and we'll get into that when we look at some of the CDS issues, but I want to jump over to the CDS issues because that's the big story of the day. Of course, that was broken initially. It was covered by TF Metals. He did a great job. Turd Ferguson did a great job on TF Metals on covering this, and I've got it on my blog. The interview with Ellis Martin, that was James Sinclair, and I don't have time to go through all this, but to basically summarize, Jim Sinclair said that the 5 banks or so in the United States that have the massive exposure, I think the percentage he used was 97% of the CDS credit default swaps are written by these large U.S. banks, so they have exposure. We're going to get into that when we look at the definition in the Wikipedia on CDS, but it was also covered by Ann Barnhart. I've got that here on the blog. And of course, you remember Ann, she was the one who came out when MF Global went bust and said that basically that's it. The game's over. I'm closing my brokerage and I'm done. So, I wanted to go over real quick to the Wikipedia on the credit default swaps because, as you can see here, I was doing some research for tonight, and you can see that it is a gigantic explanation here. So I have no way of creating the time to go into this. So I just wanted to point out a couple of things. The first thing I pointed out, I actually made a comment on the Jim Sinclair article on YouTube, was, and Ann Barnhart actually said the same thing. What I said was, that's interesting, the definition that you use for default. I would suggest that you try using that definition on your mortgage lender and see how far that gets you. Tell your mortgage lender that from now on you're just going to pay them 50% per month of your mortgage payment, but that's not a default, so they can't exercise their rights to kick you off the property. Let's see how far that goes for you. But anyway, so let's try to dig into some of the definitions here. It's really a long article, but I just want to touch on some key points. First of all, a credit default swap, or CDS, is an agreement that the seller of the CDS will compensate the buyer in the event of a loan default. Okay, so those are the keys, and we really want to jump over to default because, as I'm going to look into in a bit here, we have to know what that term means. And what I found so strange about what Sinclair was saying today is that someone after the fact is going to determine what that means. So that's sort of like what I would call something that's forbidden in the Constitution. It's an ex post facto law. The concept is that people should be able to guide their behaviors by what is prohibited in the law. Any of you that have spent any time in law school, like I have, know that lawyers describe every case as a crapshoot. One of the reasons why every case is a crapshoot when you take it into court is because the predictability in law is lost. So the definitions are messed up and you can't have any predictability. It's just kind of a whim thing. And the same thing is going on here with this definition of default. But if we go into this definition, you can see it's very clear. In finance, default occurs when a debtor has not met his or her legal obligations according to the debt contract. Okay, so the definition of default should already be established by the debt contract. So I'm a little bit perplexed, and it's hard for me to understand how, and we'll get to this in a second when we look at the CDS entry, but it's hard for me to understand how, after the fact, they can define what a default is when the contract itself should specifically state what constitutes a default. That would be the very thing that this contract is written for, because it is a default swap. It is a credit default swap contract that is written on the basis of this event. How could you have an event that isn't defined by the contract that is written for it? So that's really strange, and that's something I don't understand. But let's dig a little bit into the credit default swaps. There's a couple of highlights I noticed when I was going through this. A credit default swap, CDS, is an agreement that the seller or the CDS of the CDS will compensate the buyer in the event of a loan default. The buyer of the CDS makes a series of payments, the CDS fee or spread, to the seller, and in exchange receives a payoff if the loan defaults. Remember, that's what we're looking at, the definition of default. In the event of default, the buyer of the CDS receives compensation, usually the face value of the loan, and the seller of the CDS takes possession of the defaulted loan. However, anyone can purchase CDS, even buyers who do not hold a loan instrument, who have no direct insurable interest in the loan. And they're going to, further down here, they're going to explain that's the reason why this isn't technically insurance, because in an insurance contract, you have to have a direct insurable interest. In the case of these CDSs, anybody can just place a bet. So we're going to go down and scroll through this. There's a lot here. There's the description, of course, and there's the explanation that it's not insurance. There's the explanation of risk, which is very puzzling because, and if you remember my review that I did on the credit rating agencies, this is something similar here. You have a non-market sort of operation going on where you would think that, well, the market can just take care of this stuff by pricing it, but then when you dig deeper into it, you can see that the stuff goes from AAA to zero. So obviously there's a lot of problems with that model. Now we talk about speculation. I wanted to look at the history here because it's very interesting when we look at the people involved. Conception. Forms of credit default swaps have been in existence from at least the early 1990s, with early trades carried out by Bankers Trust. Morgan and Company, J.P. Morgan, is widely credited with creating the modern credit default swap in 1994. In that instance, J.P. Morgan had extended a $4.8 billion credit line to Exxon, which faced the threat of $5 billion in punitive damages for the Exxon Valdez oil spill. A team of J.P. Morgan bankers led by Blythe Masters then sold the credit risk from the credit line to the European Bank of Reconstruction and Development in order to cut the reserves that J.P. Morgan was required to hold against Exxon's default, thus improving its own balance sheet. So it goes on and on and on and on and on. You can see it. There's all the mathematical formulas, etc. It's very complicated, but it's also really very simple. The key concept is that it is a promise that if someone else fails to pay their obligation, then the person who sells this insurance will have to pony up the amount, and they will get the bad risk, or the whatever's left of the bad debt instrument themselves. And so the main point is that Jim Sinclair and Ann Barnhart as well are alleging that we're going to have another haircut. Now, if you remember, we had a haircut of 50%, and they declared it not to be a default. Now, I don't know how that works. It doesn't make any sense to me. It seems to me that the contract itself will say what the definition of a default is. I don't know how some ex post facto agency can come in after the fact and say whether or not it's a default. And of course, Ann and Jim ask, well, where's that line? Is it 75%? Is it 95%? 99%? Where's that line? So if they default on 99.999999999% of their bond or their loan or whatever, that's not a default. So you can see that we're bordering, and Ann points out that either way it goes, there's going to be big trouble. So, and others have pointed out that it's probably going to cause a rush into the physical assets. And of course, that's the name of the game. The name of the game is silver and gold. As many people have pointed out, and I've argued against them time immemorial, I've had to make this argument, that silver and gold are not just inflation hedges. These metals are default hedges. When you have a debt obligation, when you have a promise, when you have a potentially broken promise, then you are at risk. You are potentially at more risk than if you have just a weakening of the currency that goes on over a long period of time. There's a potential risk that the person who's made a promise to you will break that promise and simply won't pay you anything. Of course, silver and gold are not debt obligations. They are wealth in and of themselves, and therefore they are a separate system outside of this system of debt promises. And of course, when the rest of the public, which is still a very tiny minority, realizes that these assets are not debt instruments but are valuable in and of themselves, of course, they're going to rush to these, and we're going to explode to the moon at that point. And we'll talk to you next time.